G'day everyone, Stefan and Tom here from Angel Advisory. Welcome to the Real Wealth Podcast. That's enough of an intro. Let's get into it. We're here today to talk about a private credit and whether or not that's going to be the best performer within fixed income for 2023.
Finally, the unsexiest asset class has become the sexiest.
True.
That's the way I put it.
Fair enough.
Yep, it is. Fixed income in general is the most boring thing and one of the hardest things to get your head around. Private credit's a bit easier. And that's the reason we love it at the moment is because generally if the Reserve Bank is putting up its interest rates or the cash rate, then your return on this private credit is also increasing because it trades off a margin.
Right.
There's things like hybrids and things like that, which we'll go through. Before we get into it, I'm going to give the disclaimer because I like being the fun guy. Anything you hear in this podcast or recording is just general information. Please don't consider it as personal advice. And if you want to consider any personal advice, please go and consult your licensed financial planner. That's it.
That's it. That's the official stuff done.
That's it.
Cool. Right. So let's talk about the sexiest asset class for 2023.
That's what I think. Because everyone talks about doom and gloom. There's a lot of wording around recession in 2023, not knowing where asset classes are going. And look, we're recording this at the start of Feb. January has been a stellar month, but people are still scared.
Yeah.
They're still skeptical about where the world's going to go.
Yeah.
And obviously property starting to get impacted because interest rates are increasing. Share markets are traded off future expectations and they're getting better, but people still are unsure what's going to happen in that asset class. But if we look at fixed income or some of that more defensive in nature, made up of two components, right? Two components being one, government bonds, long-term lending to secure organizations. And then there's more, we call it the riskier. It is a bit riskier, private credit or things that like bank hybrids, anything to do with lending people money, lending people or companies money. That's what I think is going to be the sexiest and the best, one of the best anyway, like in terms of like what you can expect from the markets. A more stable returner for 2023.
Yeah. So with fixed income and specifically private credit, as you've mentioned, do you consider that to have been boring in 2022 or it's always been boring and it's about to have its moment in the sun?
It's always been boring. It still is boring.
Okay. Okay. It's boring, but sexy.
It's sexy. Okay. So 2022, it sucked. It wasn't good.
Yeah.
So this is why a lot of people ended up going out, buying shares, buying, say, commercial properties, because if you're looking for an income return, then when the Reserve Bank's cash rate is low, then you're not going to make a great return off things like term deposits or any of this private credit or lending money because it's all pegged against, it's a margin on top of the Reserve Bank's cash rate. It's the easiest way to value it. So in 2022, when the Reserve Bank's cash rate in Australia was at 0.1%, you weren't making any money. Whereas Australian equities were paying out 7% income returns. And if they're fully franked and you're making 9 or 10, you go into the commercial property market, you're making a 6% income and you got uplift coming over there. But now, over 2022, the Reserve Bank's gone from 0.1%. We're in Feb now, 3.1%. That's their cash rate, and it's going to keep increasing. Now, if it keeps increasing, these investments also keep returning more as the Reserve Bank keeps kicking up its interest rate or its cash rate, which is why if you've got uncertainty in the market, everyone's pretty confident that interest rates are going to continue to rise, and therefore you can continue to make higher returns.
Right.
These kinds of investments, but they are investments.
Yeah. So you're anticipating for this year that there'll be a shift from the focus on securities from last year, heading towards fixed income, towards private credit, because of those trends that you've mentioned.
The income's so good. So if you, for instance, if you want to double your money every 10 years, then you need to make 7% per year annual return.
Yeah.
Now, some of these things you're getting a 7% income return on some of these debt items. You're getting up to 9-10% on some of them. It all depends on how much risk you want to take. So for the less risky stuff, let's say you borrow money to a bank. Banks are you'd say a bank is fairly reputable, most likely going to pay you back. Banks issue this kind of debt over what's called a hybrid. So they go to the market, say, we want you to borrow money from us. We'll give you the Reserve Bank cash rate plus like a 2% buffer.
Yes.
So if you think if the RBA cash rate's at 3%, their buffer's 2%, and they might pay a 5% income return.
Yeah.
But that's publicly traded. So you've got the equity risk there. As the RBA cash rate increases, so let's say it goes to 4%, then you're not making 5%, you're making 6%, which is not bad. Then you got the riskier nature, which is out there. So lending money to institutions that then lend to individuals or that lend to business owners. And that's where you start getting that margin that I spoke about, that 3% plus 2%. You can go up to 3%, 4%, 5%, 6%. But as you go up, it starts getting riskier and less diversified.
Yeah.
And when I talk about diversity, when normally people think about diversification, they think about, right, I'm going to invest in a lot of different things. But in this private credit market, it's in how many loans are there? How diverse is the loan pool? Because let's say you've got 20,000 lenders. If you've got 1,000 of those that don't end up paying back, well, that's only 5% that don't end up paying back. But if you've only got 5,000 and 1,000 of them don't pay back, that's 20%. You don't want that because that puts your money at severe risk. So you've got diversity, less diversity will get you more, obviously. And then the security of the borrowing. So for example, if you're lending money to an institution that then lends money out for, say, real estate's pretty secure. They might have a loan to value ratio. They do their assessment under the responsible lending guidelines. If they're under that framework, then you're pretty secure that you're pretty confident that the money will get repaid.
Right.
But then you can go down the track and say, well, what if this institution lends money to individuals as personal loans, or they lend money to business owners to buy cars? That's riskier.
Yeah, okay.
There's a lot of likelihood this might not go too well.
Yeah.
So then but you get a better income return. So it's riskier in nature, but you get rewarded by a better income.
Yeah. Okay.
So it's really important to do your assessment on the lender, the criteria, who money goes to, and what happens if people don't repay the money.
So there's a bit of a scale that exists there where, in terms of, I mean, correct me if I'm wrong, but the low risk, low reward, you're looking at government bonds as an institution that's safe.
Government's going to give you the money back.
That's
right?
it.
Yeah.
Medium tier would be banks, the major banks.
Yeah. Well, you've got even the low. Another pretty secure way of getting your money back is, say, term deposits.
Yeah.
Lending to a bank, they do what they want with it.
Yeah.
But they give you the money back.
Yeah.
At the end of the point, and the government guarantees that money up to $250,000.
Yes. Yeah.
So that's another pretty secure way to earn a good return.
And then beyond that, moving into property, what you mentioned, it could be a safe investment. It might not be, which is why it's important to do your research. Then you're looking at higher risk, higher reward.
That's it. Like with anything.
Yeah.
The more you move up the risk curve, the better your return should be getting. So it's about doing your assessment. Do I want to take on that risk? Do I want that extra income return? How actually safe is it? But that's normally the trade-off. The more return you want, the more risk you end up taking.
For sure.
But in times of uncertainty like we're in, no one really knows what's going to happen in 2023. A lot of people want security of their money. And that's why we're seeing a lot of people move towards this private credit, because if you can get 6 or 7% with taking a minimal risk compared to the equity risk you'll be taking, or the property risk you're taking if you're not seeing the property market going anywhere anytime soon, or even in the short term. We're seeing a lot of people love this stuff, and especially people that are sitting on cash, not knowing what to invest into. Just because 2023 is an uncertain year. Uncertain.
Well, if you can get 6 or 7% plus the peace of mind, I mean, that's invaluable. What we've learned from our clients is that peace of mind is priceless. Like the security of that investment.
Yeah, that's right. Financial security, comfort, all play a part in making your investment decisions, especially as you get more money.
Yeah.
Over time.
Oh, very good. All right. Well, we might wrap that one up here. Thanks very much for your insights on the fixed income in general, but also a specific look into the private credit.
Good stuff, mate. Thanks for chatting.
Thank you. Looking forward to a sexy 2023 as well. Apparently that's what it's going to be.
Thanks for listening. Bye.
Cheers.